Hi, everybody, and welcome back to video number 2 in Chapter 10. When we left off, we were looking at the declining balance method. This should be a bit of a review from your previous courses, but here, this is the second decreasing charge depreciation method. It's called the declining balance method, and it determines depreciation expense by applying a constant percentage to the declining book value of the asset each year. So here are the steps. We're going to determine the declining balance rate, and that's going to be, in the case of double declining balance, that's going to be twice that of the straight line rate. Then we'll multiply that rate through times the book value of each year. That book value will be declining. And then we'll repeat that until it reaches the salvage value. And then we will not decrease that book value further than the salvage value. Okay, let's look at that. Here, our old friend Gordon Dining Services uses double declining balance method. So how are you going to compute the depreciation expense over that 5-year period? Well, here's how we would do it. We're going to start here by knowing that the straight line rate is 20%. That's 100% divided by the 5 years, right? So that's going to be 20%. We double that to get the double declining rate of 40%. Now we'll start not with the depreciable base, but with the assets acquisition cost of $500,000 multiplied by 40%. That gives us our depreciation expense. When we subtract that, this is our first accumulated depreciation. We're going to subtract that from 500,000 to get to book value at the end of the year. Now we start the process over. We bring the 300,000 over to here, multiply by 40%. That gives us $120,000. That increases the accumulated depreciation by 120,000 and decreases the book value by that 120,000. And we do that all the way to year 5 in this case. Now here we have 14,800. If we were to multiply 64,800 times 40%, we're not going to get 14,800. This 14,800 is what I call a plug figure, because I know that I'm at accumulated depreciation here of 435,200. I need another 14,800 to get to 450,000. 450,000 is my depreciable base. I don't want to go below 50,000. So I can then plug 14,800 in as my final depreciation expense. Okay, that's a little different than straight line depreciation, where we take the salvage value into consideration at the very beginning. Here, we take the salvage value into consideration at the very end. All right. All right. Group method. Here we use that when assets are similar in nature and have approximately the same useful lives. It closely approximates a single unit cost procedure because any deviation from the average amounts in most cases is not that material or great. The other approach here is composite method, and that's used when the assets are dissimilar and have different useful lives. And essentially, we're going to do the same thing as the group as the group method in our calculations. So let's take a look at composite depreciation. Alaska Adventures provides you with the following information for its fleet of cars, trucks, and campers. And so originally, here's our cars, trucks, and campers original cost of $224,000. Estimated salvage values, $34,000. So our depreciation base is $190,000. We have various estimated useful lives for those assets. And so now our depreciation per year is our depreciation base divided by the useful lives. So how would you compute the average composite depreciation rate? How would you compute the length of time it takes Alaskan Adventures to depreciate its assets, often referred to as the average or composite life? Well, under the first question, alpha here, Alaska Adventures will depreciate the group of assets to their salvage value of $56,000 per year. The average composite depreciation rate is the depreciation per year divided by the original cost, or 25%. So we're going to take the $224,000 original cost and divide that through by the depreciation per year in total, and that is going to be 25%. So the average life then is going to identify the time needed to depreciate this composite account. In this case, the average composite life is 3.39 years. We get that by taking the 190,000 here and dividing it by the 56,000. Okay. How do we disclose group depreciation method? Here, AT&T shows us a note 1 in their summary of the significant accounting policies. And it shows certain subsidiaries follow the composite group depreciation methodology. And accordingly, when a portion of their depreciable property, plant, and equipment is retired in the ordinary course of business, the gross book value is reclassified to accumulated depreciation, and no gain or loss is recognized on the disposition of these assets. Okay, single unit method. Advantages: it simplifies the computations. 2, it identifies gains and losses on disposals. 3, it isolates depreciation on idle equipment. And 4, it represents the best estimate of the depreciation of each asset, not the result of averaging the cost over a longer period of time. Accelerated method comparison. Here, our Lynch Incorporated purchases equipment with a 5-year life for $10,000, no salvage value, on July 1, 2025, halfway through 2025. The company's fiscal year ends at the end December 31, 2025. Lynch decides to use either the sum of the years digit method or the double declining balance method. How would you compute depreciation for these two methods for the 3 years? Okay, sum of the years digits method. We would add the 5, the 4, the 3, the 2, the 1 together to get 15. And then we take 5/15, 4/15, 3/15 of $10,000, right? All the way through. And for the partial year, depreciation from July 1 to December 31, 2025, we would take 1/2 of this $3,333.33 to get to $1,667.67. Okay, then we would take half of the next year plus half of the next year and kind of stagger those numbers forward. Now, if we use the double declining balance, we would take twice the straight line rate, which is 40%, and ripple it through the book values of that company. Again, using 10,000 to start. Even if there had been a salvage value, we would not have changed that $10,000. There was not one in this case, however. So we would do the same thing. We would take half of the first year, and then we would stagger those numbers through as shown. Okay. I think you can see from this why we almost always used a fixed asset system to calculate all this. It gets very complex when you're doing this in partial year terms. Remembering, of course, that for tax purposes, we can use accelerated depreciation, but for book purposes, we normally would use straight line depreciation. Okay, so the fractional year depreciation policies here, we're showing an illustration of that, and our total cost or depreciation was $45,000 here. So our nearest full month then is going to be $5,250, and that's going to be calculated by taking 7/12 of $9,000, and then under delta here, where are you, delta? There you are, $3,750. We calculate that by taking 5/12 of $9,000. And so you can see that we can't increase the total depreciation, right? We have to, in total, cannot exceed the $45,000. All right. Also, Makers uses generally a half year or quarter year convention. And if you look at those charts, you'll see that. Again, a good reason to use a fixed asset system for calculating these in the real world. Okay. Depreciation and replacement of property, plant, and equipment. There is a common misconception about depreciation is in that it provides funds for the replacement of fixed assets. Not true. Depreciation is like other expenses in that it reduces net income. It differs, however, and this is a very important concept, in that it does not involve current cash flow. It's a non-cash expense. Okay, if I take a look at these depreciation rates, sometimes we need to revise them. And that's okay. Companies may need to revise or review their estimate during the life of the asset. Unexpected physical deterioration or unforeseen obsolescence may decrease the estimated useful life, or improved maintenance procedures and revisions procedures may prolong the life of the period. That looks like a good place for us to stop this video. And when we return, we'll take a look at computing accumulated differences due to revisions. Until that time, bye for now.